Hi. So welcome back everybody. I know I haven't been extremely active over the last 1.5 weeks or so. Please pardon that. Essentially, I hope you guys all had a great Chinese New Year. For those of you who do celebrate. For those that don't, the markets continue running up and down. It's an extremely volatile market, which is why I'm back to essentially just cover anything stock market related. And there's been quite a lot of exciting developments over the last 1.5 weeks to 2 weeks. So I'd just like to provide a little bit on my opinion thus far and moving forward, of course. So please remember to smash the like button if you haven't, and let's get right into what we wish to cover. So on this week's weekly update, I don't think it will be an extremely long one. Just gonna review and look through and reflect on what has happened and how would it affect our investment decisions and how we are going to quote-unquote buy the dip. So before I start, I'll run a very short clip from Professor Damodaran. So Professor Damodaran is considered one of those quote-unquote finance god professors, at least in the teaching faculty and fraternity. And I think a lot of finance-related profs also look up to him quite a lot. So I'll just play a very short clip about him explaining expected inflation versus unexpected inflation and what are the implications specific to our own stock portfolio and how do you play this entire inflation problem.
Now, if you think about inflation, we tend to think about inflation as a number, but I think it's actually much more useful to break inflation down into expected inflation and unexpected inflation. Sounds like I'm playing with the number, but let me explain why there's a big difference between expected inflation and unexpected inflation. As investors, as businesses, if you have expected inflation, you can incorporate it into your decisions. As bond investors, for instance, you can bring in that expected inflation into the interest rates you charge and cover the inflation. As businesses, you can try to charge higher prices because you know inflation is coming, you can build it into your costs. I tell people, look, if inflation is 10%, but it's guaranteed to be 10%, investors and businesses will learn to deal with it. It's unexpected inflation that blindsides us because we can't plan for it. We set an interest rate based on expected inflation. If actual inflation turns out to be higher than expected, we're blindsided. We end up losing returns. So I think it would be useful to break inflation down into expected and unexpected components. And here's how I'm going to do it. I'm going to cheat. I'm going to use the average inflation over the last 10 years as my proxy for expected inflation. Now, for the last 20 years, we've had more sophisticated proxies, as I showed you, the T-bond minus the TIPS rate. But since I'm going back all the way to the 1950s, this is the 1930s, 1928. The proxy that I am most able to do is to compute actual inflation rate minus the average over the previous 10 years. If you look at this chart and you look at the columns at the bottom, that is actually unexpected inflation. So when that's a negative number, inflation is coming in below expectations. When that's a positive number, inflation is coming in above expectations. If you look at the 1970s, you had a decade where inflation year after year came in above expectations. If you look at the 1980s, year after year, inflation is coming in below expectations. You might say, so what? No, it's tough to read in this graph. But in periods where inflation comes in above expectation, it turns out that stocks and bonds don't do very well. In periods where inflation comes in below expectations, they do much better.
Now, I wouldn't be spending too much time trying to break it down. I think Prof. Damodaran actually broke it down quite succinctly. And if you have any questions, please just feel free to leave in the comment section down below. But I would just like to expand a little bit more on one of the other concepts where he explained about the investment implications for inflation specifically. I think inflation is a core topic for 2022. And moving forward, every single month when they release CPI data, how's the supply chain issue, employment data, a lot of this discussion will revolve around this core inflation topic, which also then affects any of the interest rate hikes and how the Federal Reserve will position themselves in trying to control and trying to stabilize the entire economy. So I believe everybody is entitled to their own view on whether they think it's still transitory, whether supply chain problems will naturally ease out, and whether all the different countries will come in together to help fix the problem. But that said, I just wanted to talk about the implications, which is if you are in the first camp of thinking that, hey, inflation is probably a worldwide problem. Every single country is probably going to experience a same quantum or probably in the same ballpark range of inflationary pressures, then sure, it means that the entire inflationary environment will be muted, because if everybody gets worse off, then nobody gets worse off. However, if you are in the other camp, where you think that some countries will experience higher inflation while others will experience lower inflation, and there are a few numbers that can actually back it up, I think Japan is actually experiencing even deflation, minor deflation, and China is experiencing quite a substantial lower quantum of inflation. I think their last inflation reading was around 0.9 or even 1%. While on the flip side, the US economy, the UK economy, even in Europe by and large, most of them are experiencing high single-digit inflation numbers. So if you believe that this is going to be the trajectory for the entire world forward, then you might want to reconsider and to look into your portfolio again and see whether you want to make any sorts of this adjustment. Because ultimately, you know that inflation will affect some of the exchange rate policies and, more importantly, monetary policies of individual countries. So I'm not going to make a speculation here because this is really anybody's guess. That said though, I would like to caution you that for people that always try to play the macroeconomics game, in the long run, we probably cannot outsmart and outplay the market. So ultimately, I think this is just a good to know. I'm not encouraging you to take any actions. So just on my part though, I have been reading some of the fund houses' view. I've been following some of the brokers, what they've been talking about. So the fund houses, or just the bank themselves, started pivoting how they look at this entire inflationary pressure and where they think opportunities are. And they started to pivot away from the US equities and start saying that, hey, maybe Japan equities might look a little bit more interesting. And maybe even in China, valuation starts getting interesting. So these are just some of my very summarized view of how some of the fund houses and some of those brokerage firms have been talking about. And all these are public info, by the way. I think most of them actually do have a YouTube channel. So please do check it out when they talk about some of this general market trends and general market consensus. Of course, this is not any financial advice. Next, let's go to the FAANG stocks. So I think the earnings report from the FAANGs was fairly interesting, and I'm not too sure whether you guys actually follow this investor or I don't know, venture capitalist Chamath. So before this entire FAANG reporting, I think back in November or December last year, he essentially told people to long Microsoft and Google while short the rest of the FAANG stocks, which include Netflix, Apple, Amazon, Facebook, etc. So interestingly enough, after the earnings report, if you were to really categorize them into a few categories, Microsoft and Google has essentially blown out all their competitors. The earnings was spectacular. I think there was nothing much to complain about. And Apple, on the other hand, was probably in a good category, while the rest of them like Facebook, Netflix, all these have been quite disastrous. Amazon, I think it's on the fence. Some people say it's good, some people say it's bad. But personally, I feel that Amazon was a little bit on the worst side. I'm not saying that it's not a good earnings result. I think if you were to dive into the fundamentals of why Chamath actually made this opinion, or even, I don't know if people call it investment advice, essentially, I think you can look at Microsoft and Google being so entrenched and just how both companies are able to leverage on their software and their underlying infrastructure. And on top of that, they're essentially not very affected by all the supply chain issues and most of the headwinds that are affecting all these FAANG companies thus far. Now, to look into Facebook specifically, just recently I was, at least for the last 3 days or so, I've been trying to do my due diligence, understand the competitive landscape a little bit more. And of course, I have been a user of most of all these social media or entertainment platform. Facebook, Snapchat, Instagram, TikTok, Twitter, you name it, I'm probably the user of all of them. So please don't call me a boomer, but I do still use Facebook from time to time. But I would still believe that fundamentally most of the apps will have their own distinct advantages, which I'll be explaining a little bit more in a separate video. But Facebook seems like a very interesting company thus far, and a lot of all these Alibaba investors are probably also interested in Facebook currently. And it's quite funny because if you were to think about it, the investment profile of an Alibaba investor probably shares similar characteristics. They like companies that are trading at a cheaper valuation. They like companies that are embroiled in problems. And if you think about it, Alibaba is the face of China and the face of this entire crackdown. Whenever there's some problems between US and China, Alibaba is the first to take the hit again. And if you were to compare with all the FAANG stocks, Facebook seems to be the face of regulation. There are a lot of issues with how the regulators are handling Facebook with regards to the rest of their competitors. So you can see from an investment psyche point of view, I understand why people are getting interested. And more importantly, it seems like at least in the value investing, I quote unquote, I'll use the word value investing community, more and more people are also trying to say that, hey, Facebook is of deep value. I'm currently working on a video. I'll be releasing it probably sometime soon, maybe on Tuesday or Wednesday, to share with you my opinions on Facebook specifically. But yes, I'm getting slightly interested. So currently I do not have any position in Facebook, so I hope that my views are probably a little bit more objective. Now, at least in today's stock market, I think people are always saying that, the stock market might be overvalued, because there are too much quantitative easing, there's too much easy money, so the stock market is bound to fail or it's bound to correct, etc. But I think back to Warren Buffett's timely wisdom, there are only two things that bound the stock market's performance. Number one, it's the company's earnings. If the companies continue to grow, the fundamentals continue to increase, and most of the companies in the stock market continues to deliver stellar performance and beat expectations quarter on quarter, year on year, I don't believe that the stock market is overvalued, especially because the characteristics of a stock market is inflationary in nature. The second part then is interest rate, because Warren Buffett did say interest rate acts like gravity to the stock market. So this is the second part of the equation where investors start to get a little bit jittery. Right now, I can tell you that most of us probably don't exactly know what's going on. The stock market is just trying to front run this entire problem, and they're trying to guess that, hey, how much is the Federal Reserve going to increase interest rate? How long is this supply chain problem? Is it pervasive? Is this problem sustainable? And are there short-term headwinds, and how they're going to play the market? Which is why it is extremely volatile, and I don't expect this volatility to end anytime soon. So which is why even if I'm interested in Facebook, I might sit on the sideline a little bit more and see and observe how things are going. So with that, these are just my general takeaways on what exactly transpired in the stock market over the last 1 or 2 weeks or so. So please share in the comment section down below what are you currently looking at, what are the risks involved, and what's your entire overview of this market. So I'll see you in the next video, but more importantly, I'll see you on the moon. Goodbye!